Hi, everyone. Welcome to Fundamentals Unfiltered. It is the week of September 15th, 2025. I'm just going to begin by saying, this is a new show. I don't have an established audience as other people do, but I think it is the responsibility of anyone with a microphone in front of them to condemn with the greatest severity and without qualification the rising political violence in this country. And I am specifically referring to the murder of political activist Charlie Kirk on um, a Utah University campus last week. And of course, this has been dominating the news, rightfully so. I stay away from partisan politics as much as possible. I didn't know a lot about Charlie Kirk other than he was an activist, very much involved in university campuses, had a huge following, was very critical in the election. But regardless, political violence is never, ever the answer. It's never going to lead to anything good. And I just hope that we can get into some more constructive discourse in this country. That said, the Federal Open Market Committee is meeting in a couple of days, and Lisa Cook, who is one of the board governors that the president has been trying to terminate, she is going to be at that meeting. We had an appeals court reject the president's appeal to try to terminate her. So she's still going to be a voting member of the FOMC while the longer term legal drama plays out. And of course, the issue at hand is that she was accused of fabricating or at least claiming two residential properties as her primary residence, and that's all playing out. And it's uncertain whether that can be interpreted as for cause. In any event, she will be at that meeting, and also at that meeting will be Stephen Myron, who is taking a leave from the Council of Economic Advisors to serve on the board. This is temporary, but the Senate did confirm him. This is the board seat vacated by Adriana Kugler, and he will be at that meeting as well. The market is expecting a rate cut of 25 basis points. I think the problem in getting a larger cut is that we still have a relatively weak job market, but we also have inflation coming in well above the Fed's 2% target. Core inflation was well over 3%. And this is going to make it a little bit of a challenge. Of course, the Fed has to try to manage inflation expectations, but we did see longer term yields come down. The 10-year has been yielding around 4%, so this should lead to lower mortgage rates. I think that will be good for housing. And I think we're seeing a lot of refinancing in residential real estate. So that's certainly a silver cloud in the economic picture. The 30-year bond rate is coming down. I think it was about 4.65% last time I checked. So we'll see how that pans out. The minutes of that meeting, which I'm always interested in reading, don't come out for a little while. So we'll just have, news of the almost guaranteed cut, probably again 25 basis points, and we'll see what comes of that. Two issues that I want to talk about today, though. One is the president has been calling for the end of quarterly reporting. This is something that he talked about in his first term, and it's really an interesting issue because it's not a new issue. It's something that's been persistent for a while. But there's really two sides of this argument, and I'm pretty sympathetic to it. One is, we sort of have what a lot of people call quarterly capitalism, which is companies that are pandering to quarterly earnings at the expense of longer term initiatives. And what does it mean when companies are when companies have such a short term focus? And you can certainly make an argument that this is more a function of institutional money manager behavior and retail investor behavior than it is about quarterly reporting per se. But I think it's a very valid criticism. It's not clear to me whether ending quarterly reporting would really do anything in terms of having companies have more of a long-term focus. But this is a really important issue for individual investors. And as much as that is a kind of on the pro side of the argument, and another thing on the pro side of the argument is it's very expensive for companies to do these quarterly filings, even though the financials that are in the quarterly filings are called 10Qs, by the way. And they're expensive to prepare, they're expensive to file. That's obviously more onerous for smaller public companies. So you could sort of point to the expense. I think what the president has talked about is maybe companies report every 6 months instead of quarterly. But I think the cons, I think the list of cons sort of outweigh the pros on this because, big institutions that can meet with management and have big research departments, it gives them a huge advantage if individual investors no longer have access to quarterly numbers. Just because those numbers are not reported doesn't mean that information doesn't exist. It's just a matter of who has it. And you could also make an argument that you might have more insider activity. Now, not all insider activity is illegal, but a lot of it is. So there's an issue about the integrity of markets. There's an issue of business trends being, happening with greater frequency, and quarterly numbers are necessary to look at trends. I read 10Qs all the time. It's very important, I think, to understand the short-term trends that a company is going through. It fills in a lot of blanks. So I do think that it puts individual investors at a major disadvantage over institutional investors. So we'll see how this plays out. I'm sure a lot of interested parties are going to weigh in with their lobbying efforts, etc. But, again, this is something the president has brought up in his first term and is bringing up again. And it's something people in the industry have talked about a lot, one way or the other. The other issue I wanted to bring up, I touched on this in a previous video, and that is the liquidity issues that are going on in the private equity world. This is interesting. In the Financial Times, there was an article, it was an editorial by Katie Martin. It was titled "The Strains on the Private Equity Model Are Showing." And the idea was, with the private equity world facing liquidity issues, they're increasingly using what are called continuation funds. The way continuation funds work is that when a private equity firm has a fund and they buy a company, they're looking for generally a 5 to 7 year exit. And in the last few years, they have had a very hard time exiting positions at prices that they find satisfactory or that would yield a satisfactory return. A lot of these firms bought positions in the low interest rate environment prior to COVID, around COVID, and they paid big valuations for them, and they're just not getting the valuations on the exit. So what a continuation fund does is it allows a private equity firm to create a new fund and sell the companies that were in the previous funds to the continuation fund. So essentially the PE firm is selling a company to itself. But this allows them to close the previous fund and hold on to the position until they can get a better exit. Now, there's a more cynical way there's a less cynical way of viewing this, but to me, it also it highlights the liquidity issues that I brought up in a previous video because, you know, the private equity industry at large, there are plenty of exceptions to this, but at large, the private equity industry is facing a major liquidity crunch because of these lack of exits. And the institutions that fund this, the college endowments and the charitable endowments, the pension funds, the big institutional investors that participate in this, their money is being held up in the existing funds. So the private equity industry has been looking for new sources of capital. And I think this is one of the big drivers of the private equity industry lobbying to tap into retirement savings. Now, there are certainly arguments in favor of this that would suggest that it's a good thing. For example, the number of public stocks in the last 25 years has roughly halved from over 8,000 to maybe a little over 4,000 in the US. So the available pool of investments just in public markets has shrunk. Private markets are very robust, and so there's certainly an argument of trying to give greater choice and greater access to individual investors through their 401ks. Now, individual investors can invest in private markets through IRAs, what are called self-funded IRAs, but they have not really been able to do so with 401ks, which is a lot of where retirement money is. So I think these increased use of continuation funds, and in this article it was a little bit focused on the UK. The Financial Times is UK paper, but there have been a lot of articles that have come out highlighting this trend in the United States as well. I think it's just another manifestation of these liquidity issues. So it's just something to keep in mind as these private deals become more available to individual investors through their 401ks. I think healthy skepticism in this area is very good. I've talked a little bit about, some of the other private investments that are made in, particularly through the Jobs Act. But in this case, what we have is years of lobbying efforts that have from the private equity industry to sort of tap into this new pool of capital. And again, it's hard for me to look at that and not see that being related to the liquidity issues that they're facing. So again, it's just hopefully we have consumers in this space that are informed, and I think it's important that we highlight some of these things. So with that said, over the next however many months, we'll get more clarity on what private market investing in 401ks is going to look like. But like I said, just industry-wide, this major liquidity issue is ongoing, and I think it's a big driver of this. That said, we will wrap this up for today. Thank you, everyone, for listening, and I wish you best in your investment endeavors.